Good afternoon, class. Welcome to week 15. Hard to believe that we've made it this far. So today, we're going to do a couple things. We're going to finish up chapter 12. We started it a while ago, like 2 weeks ago. So if it's okay with you, I'm going to start from the beginning, and we'll be able to go through probably a little quicker this time. But then we'll probably finish up maybe halfway through class. And then I want to go through homework for chapter 12 with you after that. All right, so this is about risk, returns, and capital budgeting. And the whole premise of this is, how do we come up with an expected return for a stock? Because this is kind of where we get the discount rate for that financial analysis we do. It depends on the required return from investors in a company. And so what this is specifically looking at is the stock investors for a company. What's their required return? And long story short, we're going to look at, when we look at a company, we're going to look at their stock, and we're going to try to compare it to the overall market to come up with an expected return. That expected return is kind of our discount rate, basically, for an average project for the company, assuming they only have stock investors. They don't have like debt investors. They don't have other types of preferred equity, that type of thing. This is just for stock-only companies. So to get there, we're going to learn about market risk. I say learn because we kind of covered this, but again, it's 2 weeks ago, and I thought instead of introducing new material, chapter 13 today, I felt that the timing wasn't good for that. So I thought it better. Let's just cover chapter 12 since it's been a couple weeks. Let's get it down, and let's lock it in and get ready for that final quiz so we can all be successful. So back to the slide. So calculate, interpret market risk, which is going to be measured by beta. So every stock has its own beta. Even a portfolio of stocks will have its own beta. And that beta represents how sensitive the stock's return is to the market return. And consequently, that beta is also how we measure market risk for a stock. The model that we're going to use to calculate the expected return for a stock is called the CAPM, also known as the capital asset pricing model. And it's this CAPM that we're going to use as our discount rate for a stock-only company. And you can think of it as the opportunity cost of capital or the required return for investors. So this is that discount rate that we want to use when we analyze investment projects for a stock-only company. Notice I keep saying stock-only because in chapter 13, we look at when a company has stock plus bonds, and we kind of have to take a weighted average of those two returns for the whole average company. But anyway, we're not doing that. So how do we measure market risk? Well, first we have to make some couple definitions. The first one is, what is the market portfolio? And the market portfolio is basically a portfolio of all the stocks available in the market. And in practice, when we talk about how the market's doing, what's the return of the market, we don't have a single portfolio with every single stock. What we do use instead is a portfolio that represents most of the market. And that portfolio are usually publicly available indexes that all the major financial websites and newspapers basically talk about every single day. We can go to the Wall Street Journal right now, and you'll see on their front page that they will show indexes for the U.S. The U.S. will say DJIA, which stands for Dow Jones Industrial Average. It will also have SP 500, which is the S&P 500 index. And so that's what's popular in the US. Other areas of the world, in Europe, we would have something called the FTSE, FTSE. I think it's the FTSE 100 or the FTSE. Yeah, I think the FTSE 100. It sounds like a game, right? The FTSE, but it's FTSE. It stands for the Financial Times Stock Index or Stock Equity, but it's basically the London, stock exchange, the index for that market. Then we have the DAX, the DAX, which is the German stock exchange. Then we have the CAC or the CAC 40, and that's the French. Then we also have the Hang Seng. We have the Shanghai in China. We have the Nikkei in Japan. So we have, we have these indexes all over the markets across the world, and they all basically represent those stock markets. And that's what people look at. And that's how they measure their performance when they ask, how did you do compared to the market? Well, you're asking, how did you do compared to the S&P 500 index? And then the second definition is beta. And beta basically measures market risk, and it's the sensitivity of a stock's return to the market portfolio. And we usually measure that market portfolio here. It might be the S&P 500. Like for my own research, sometimes I use a different index that's designed for equity research for academics, and it has even more stocks in it. But yeah. And so that beta is used to measure market risk. Let's take a look at how we develop beta. So on this chart, we've got stock returns in the vertical axis and stock returns in the horizontal. The vertical axis is basically the return of a particular stock ABC, minus the risk-free rate. And then the horizontal axis is the overall market return, usually like the S&P 500 index minus the risk-free rate. So these are basically risk premiums. I think that definition is coming up in a couple slides, but whenever you see a risk premium, it means you take the return minus the risk-free rate. Then the next thing we do is we collect historical data of the stock return versus the market return. And so all these little dots here are basically the stock return for a particular month and the market return for a particular month, all plotted on this chart. And so you can see how a stock's return, how it moves in relationship to the market. And so we got it. And if you look at it, it almost looks like it's pretty linear, right? So we could create a best fit line using linear regression here, and the line might look something like that. Now, the next thing we have, when we have a line, we're going to have a slope, right? And it turns out that the slope of this line on this graph is beta, right? So take a look. I don't know this. Look at this data point right here that I'm doing a little circle around. So when the market return, it was about, it looks like 11%. The stock's return was about 0.8. Was about 8%. That's how you read this. And so that means this stock is going to have a beta probably less than 1 because the stock's return doesn't go up the same amount as the market return. So now think about total risk from chapter 11. Remember, total risk was made up of unique risk plus market risk. And market risk is measured by beta right here. Unique risk, we don't really measure because a lot of the assumption built into today's lecture is that we're able to develop a big portfolio of stocks from like an investor's point of view. And so as long as an investor is diversified enough with a big enough portfolio of different stocks, they don't have to worry about unique risk. So remember, unique risk kind of goes away. Once you have 10 to 20 stocks, you can pretty much control it. And then what you're left with is market risk. And so that's why we spend most of our time talking about that. So now that we have a beta for a stock, How do we take that and calculate the beta for a portfolio? Nice thing about that is it's fairly simple, and we basically just take the weighted average of the betas of all the stocks in the portfolio. And here's the equation. So the percent of your portfolio invested in stock 1 times the beta of stock 1 plus, then you do that for every single stock in your stock portfolio. This equation just does it for 2 stocks, but you can do it for 3, for 4, for 5, for 6, and on and on and on. Now, if you did have every single stock in the market in your portfolio, when you calculate beta, you should get 1.0. Because essentially, if you own the same stocks in the same proportion as the overall market, then your portfolio is going to move one to one with the market portfolio, and therefore it should have a beta of 1.0. Because remember, beta is that sensitivity. So if you're moving exactly the same, it's kind of 1.0. If your portfolio moves less than the overall market, then you're going to have a beta of less than 1. This was just a selection of betas, and basically the key thing here is when you have companies that are kind of like slow growing and not a lot happens, even if we have a stock crash, the company still kind of does okay. Those are companies with low betas. And you could think of something like a utility stock, where like maybe PG&E is not a good example because of some of the issues there, but most utility stocks, they'll have low betas because they kind of just chug along and kind of make a profit no matter what happens. But then you have some stocks that'll like go through the roof if the economy does well, but then they might also plunge really, really far if the economy doesn't do well. Those are high beta stocks. Here's an example of a portfolio of high growth stocks, and you look at the beta and you see it's greater than 1. For example here, when the market risk premium is 4%, we just go up to the chart here and we can see this portfolio risk premium is going to be close to 9%. So it moves much more than the stock market, so it has a beta greater than 1. This is a portfolio that is basically the same as the market. And you'll notice here that when, for example, here, when the market return is around 8%, you go up to the graph and you see the portfolio return is also 8%. Therefore, it has a beta of 1. Okay, let's talk about the market risk premium. This is what we saw in that chart where we calculated beta. It's the total return minus the risk-free rate. And this is for the market risk premium, but we can also have a risk premium for an individual stock, and we just call it the stock risk premium for that company. Here's a chart that shows beta on the horizontal axis versus expected return. And you'll see here, now this is based on having a risk-free rate of 4%. That's kind of the y-intercept term, FYI, in these charts in the CAPM equation. And then when we have a beta of 1.0, it turns out that is the market portfolio. And from this line, you can see from the beta, you can get to the expected return. And so that's kind of the equation that we're building here, that a stock's expected return is a function of the beta. So that leads us to the CAPM model, or the capital asset pricing model. And this is a theory that basically relates the return of a stock to the return of the market and how sensitive that stock's return is to the market. That basically gives us this equation right here. And this is that chart we did with all the data points for all the different months of returns. But this is not how we usually show the CAPM model. We usually rearrange it. We bring this risk-free rate over to the right-hand side, and then it looks something like this. And so this is the CAPM model you see right here. So the risk-free rate you can kind of see is your y-intercept term, right? Now we can plot this in a chart and we call it the security market line. And this is where we have beta of the stock versus the return. And the line here, which starts out at the risk-free rate, and then it goes up, kind of to the upper right, is called the security market line. And when you have a beta of 1.0, and you follow that up to the line and go over to the left to the return, that should give you the return of the market. And the equation for that line right there, the SML, is basically the CAPM equation. And again, the whole point of this is to come up with a way to create an expected return for a stock. Not the exact return. We're not saying it has to be this, but based on what's happening with the company over the recent history, this is what the market looks like it expects based on how sensitive a stock is to the overall market. And this is what feeds back into the expected return that the company has to make when they invest their money. So that's our official CAPM equation. And using that CAPM, we take the beta, and then we can calculate expected returns for stocks. So how do we apply this to the riskiness of an investment project? So the project cost of capital depends on the use to which the capital is being put. And the point of that is sometimes companies will do projects that aren't like their normal business. And so the textbook kind of makes a point of this. Even though we usually use the cost of capital for a company stock, and we use that to apply to all projects, in theory, you should really ask yourself, is this project really like all the other projects this company does? If it's not, then you have to dig down a little more detail, because it may not be right to use the company's average cost of capital if they start doing a project that's completely different than their other business. So it depends on the risk of the project and not necessarily the risk of the company. This is kind of like a little asterisk and say, FYI, yes, we usually use the stock's expected return when we evaluate projects, but asterisk, you should really double check to make sure the project is similar to the rest of the company's business. And that was my third point here, third bullet point. Most companies apply their standard cost of capital to all projects. Here's an example of calculating CAPM. It's pretty much just plug and play. You've got the equation. The equation is right there. That's the equation. And so basically we need to know the risk-free rate. We need to know the beta of a stock, the B right here, and we need to know the expected return of the market. Once we have those three things, we have everything we need to plug into that equation to get the expected return of the stock. So in this example right here, we've got the beta, the risk-free rate, and RF that's how we typically write risk-free rate. It's the treasury bill rate. And then RM, or sometimes R with a MKT or R market, is the return on the market. So these are the three things we need to use to do CAPM. And so down below here, we see the equation CAPM, and then those three pieces of information are just plugged in, and we go ahead and calculate the CAPM. So that's 17%. Okay, so we went from beta for a stock to an expected return from the stock. We can also do the same for a certain portfolio. So if we have a beta for a portfolio, we can get that from understanding the betas for all the stocks within the portfolio. So here's an example. What is the portfolio beta for a portfolio that holds 1/3 in a stock with a beta of 2, 1/3 in the beta of a stock with a beta of 1.3, and 1/3 in a stock with a beta of 0.6. So basically, we take the weighted average with the weights all equaling 1/3 of these three betas. Here's kind of the setup for the question. Let's suppose a company owns three equal-sized businesses. It owns 1/3 of its business is in the nuclear power plant parts with a beta of 2.0. Another third is in computer hard drive manufacturing with a beta of 1.3. And the last third is in dog food production. That's quite a mix. I wouldn't recommend that business mix, but with a beta of 0.6. So first off, let's calculate the portfolio beta here. And you should get 1.3. Let's go ahead and I'm going to go ahead and double check that. So I'm going to pull up some Excel here, and let's just go ahead and calculate that. So we want to go ahead and calculate a portfolio beta, right? And we have a couple things. We have the stock or business one, and let's see, we're going to have the weights, and then we're going to have the beta. And we have 2 and we have 3, right? And so each of those is equal to 1/3. So those are what we sometimes call the weights, or the percent of the portfolio invested in stock 1, 2, and 3. And then the betas were given, and those were 2, 1.3, and 0.6. So then the portfolio beta is going to be the weighted average of these. And I think the easiest way, I'm just going to do it here. So it's the weight times the beta, and then we basically go through and do that for each stock in the portfolio, right? And that gives us a portfolio beta of 1.3. Yeah. And that's what shows up on the slide there. So that's right. We've got an average beta of 1.3. So here's the question. When evaluating a new dog food production investment, which beta and cost of capital should be used? So the question is, do you use the average beta for the whole company, or do you use the beta for the dog food production? And the answer is, you want to use the one for the dog food production, because you want the project beta, if you will, or riskiness, to line up with the riskiness in your expected return cost of capital. And granted, this is a strange company, but nonetheless. But listen to this. Maybe these have similar betas, but you guys know Mars Company. I think they make M&Ms and different candies, right? They also own dog food manufacturing companies. I don't know if it's here in the U.S., but I know over in Germany they own a dog food production company, because I have a cousin over there who worked there. He made dog food, and I gotta imagine when you have different businesses like that, you do have to think about the cost of capital or the required return being different on different businesses. So the answer here is we would use the beta for dog food manufacturing, which is zero point 0.6. And so what that means then is that we want to calculate the cost of capital to use in this project. We should use the beta of 0.6. And let me switch back to Excel. So what we're going to do now is we're going to use CAPM, and we're going to use a beta of 0.6, and we're going to calculate the cost of capital. So we're going to use CAPM. And here's the equation. First, we take the risk-free rate. And if you look at the slides, I don't have them up right now, but the risk-free rate was 0.04. And then we add to it the beta, which is 0.6, times the market risk premium, which is 14% minus the risk-free rate, which is 0.04. So that would give us the expected return for a dog food project, and that would thus be the cost of capital that we have to meet on this project. And so I got, it looks like 10%. Yeah, so that would be the answer. Use the dog food beta of 0.6, and the cost of capital would be 10%. Any questions on that? And I believe that is the end of chapter 12. All right, I'm going to go into chapter 12 homework now. So question 1, a market index is used to measure performance of the overall market return. True or false? Yeah, the answer is true. We use a market index because they're readily available. They're calculated for us every single day, just about every single hour and minute. And so they're easy to use. And they are largely accurate because something like the S&P 500 has about, even though it's only 500 companies, it has at least 95% of the market value of the total market in it, even though it doesn't have all the stocks in the market. Okay, question 2. Although unique risk is present in differing amounts, individual stocks are, pick one of the above, one of the below, exposed to the same amount of market risk? No, I don't think that's the right one, right? Because we just spent a lot of time showing how market risk is measured by using beta, and all these different companies have all different betas. So that can't be right. Exposed to differing amounts of market risk. Yeah, that let's go through the other ones, but that one sounds right. C, not exposed to market risk. Only the general economy is subject to market risk. No, that's not true, because if something bad happens in the market, it hits every single company. D, able to diversify away their market risk. No, no. Remember, we had that slide. We showed how investors in their portfolios could diversify away unique risk when they owned at least like 10, 20 different stocks. But a company itself, they can't really diversify their unique risk unless they can buy insurance for it or something like that. So I'm going to say the answer is B, the second one on question 2. Question 3, beta measures a stock's sensitivity to market risks. I think that one's pretty clear, right? We spent a lot of time talking about this, so I'm going to go ahead and answer that one for us here. True. Wow, this homework is too easy. I got to redo this. Question 4. What is the beta of a 3-stock portfolio including 25% of stock A, with a beta of 0.9, 40% of stock B with a beta of 1.05, and 35% of stock C with a beta of 1.73. You know, I'm going to just use the spreadsheet that we had from lecture, and I'm going to put the data right in because I think we've already got this model built. So the first stock A, the only difference is it's A, B, C, right? Whoops. And the first stock has a weight of 25% and a beta of 0.9. The second stock is 40% of the portfolio, and that has a beta of 1.05. And then stock C is 35% of the portfolio, and that has a beta of 1.73. So that gives us a beta of 1.251. And there's the equation. You basically take the weight times the beta, and you added that up for all the different stocks. And so for us, it looks like the answer is 1.25. Okay, question 5. What rate of return should an investor expect for a stock that has a beta of 0.8 when the market is expected to yield 14% and treasury bills offer 6% return? Well, this sounds an awful lot like CAPM equation. So basically we plug everything into the CAPM equation here, and then we calculate the expected return. So why don't you guys do that right now for question 5? So we already did a CAPM calculation in the spreadsheet. So I'm going to go through and I'm going to edit that. So here is the CAPM equation that I typed in for the data that we had on one of the slides. And so let's put in the data we have in this problem. So RF was 6%. That's the first term that goes in there. And then we put in the beta, and that's 0.8 for this one. So I'm going to edit that. And then we have the return to the market minus the risk-free rate, and that's 14% minus 6%. So then I just changed this one. And so that's how we would calculate this problem right there. If I hit return, we get 12.4%, and it looks like that's what most people found as well. So that's the answer for that one. It's 12.4%. Let's go ahead and mark that one. All right, we have just 2 more problems here. Number 6, an investment project that plots above the security market line would be considered to have what? NPV. Oh, that's kind of a tricky problem. Who wrote that? I see some of you got answers already, but you know what? I'm going to go ahead and I want to pull up the chart for the security market line so we can kind of figure this out. So let's pull up that security market line. All right, here it is. And so it says in the question that it plots above the security market line. So that must mean it's plotting up here, right? And if it plots up here, it means that it has a higher expected return than, you know, the SML line, which is what you would which was kind of what you would expect, which is what investors expect for the riskiness. And if it has a higher return, it's going to make more money, more cash flows. So then it makes sense that it would have a higher NPV, right? Because if you plot it down here, you're not meeting the expected return for that your investors require. So down here would be a negative NPV. Up above the line would be a positive NPV. And right on the line itself, that sounds like a 0 NPV, right? That's kind of the break-even point. So I think the answer for above the SML line, that should be positive MPV. Okay, so I'm gonna put that positive MPV. It's not negative, it's not zero. Excessively high discount rate. Um, that's not really the right answer, right? Because the discount rate, what you're saying there is that the discount rate, if it's excessively high, then you're saying it's wrong, right? And what we're doing is we're getting the discount rate from the security market line, and so but that's not what this question is talking about. It's talking about what if the discount rate is higher than what we would normally get from the line. So um, I don't think that's really the best answer, D. So I think the best answer is A. Last question. The slope of the regression line that exhibits the past relationship between the stock's return and the market's return is what? That's the slope. That would be beta. It's not the security market line because that shows beta versus the return. What we have to do is we have to go further up here. This one right here. Here's where beta is the slope, and it shows the return of the stock versus the market return. So that's the answer for that one. It's the beta. So stocks beta for question 7.